Our next guest, this all sounds great, but our next guest warns that stocks just hit a line of death that was last reached at the peak of the dot-com bubble, although even he says there's still plenty of reasons to be bullish. Let's bring in Bill Smead, the CIO of Smead Capital Management. How's that for an intro, Bill? Welcome.
Oh, glad to be here. Look forward to talking with you.
Line of death? What line is that?
Well, it just showed that the inflation-adjusted PE ratio was a match with the dot-com, but we got other charts that show that the 10 largest cap companies are now more expensive than the 10 largest cap companies were at the height of the dot-com bubble. So this tells you a lot more about what to own and what not to own, and it doesn't tell you anything about what returns will be over 3 to 6 months, but it will tell you what returns are likely to be over 3 or 5 or 10 years, which are S&P unlikely to produce the kind of returns that people are in there for.
I hope you're wrong, because so much hangs on those returns. You know, it's and they continue. Look, we have the AI boom, and then it propels a market that looked like it was, you know, nothing was going to rescue it a couple of years ago. So look, I know there's some areas that people don't even want to hear about. That maybe we could talk about, you know, energy or healthcare. I mean, where do you really specifically think are better places for people to be invested in right now?
Well, an easy way to think about it is small cap. A $10 billion company now is small cap in effect because there's been no liquidity for it. So there's lots of companies that are very attractive because they've been left for dead or they're being punished for mistakes that they made, you know, the Targets and the Mercks and people like that. You know, the home builders yesterday, I don't think people understand. You want to buy home builder stocks when home builder sentiment is lousy, and it's been lousy lately. And you want to sell them when home builder sentiment is high and euphoric. And people don't understand that. It's all an anticipatory thing. So with the tariffs coming down, it takes a lot of pressure off of aspects of the home builders and possibly the interest rates on mortgages. And really, it's not the interest rate that needs to change. It's the spread between the 30-year mortgage and the 10-year Treasury is historically high.
Yes.
And if this uncertainty comes down, that would be in effect.
Right. And I don't know if there's anything more the administration or the Fed could do on that front. I don't know if you want to get into a whole thing about it. We're about to talk more about housing in a minute, so I'm glad that you brought it up. What about kind of more broadly, look at Thermo Fisher today. Maybe we can show a chart. The earnings were just kind of better than feared, but now you wonder, okay, maybe the whole healthcare space has been too hard hit, right? Things like that.
Yeah.
What do you think about Berkshire? The fact that that's traded so poorly. Look, I understand the risk, you know, around Buffett's retirement, but that's another one.
Yeah, we sold the last of our Berkshire Hathaway in the previous quarter. The reason is, A, there was a premium associated with him being deeply involved in most every aspect of the major investments. And then B, it's a major large cap stock. So, for example, we got a chart the other day, the cyclically adjusted PE ratio of Schiller broke the record lately. It's broken the record, right? And they looked at all the prior times that it broke the record, and over the following 3 and 5 year periods, the S&P did not make any money over those 3 and 5 year time periods, which means at some point, this momentum in the S&P 500 index, which has been great for 15 years, will become momentum in the wrong direction. So who will get hurt is the stocks that are the largest cap, because when somebody sells their position in the S&P 500, it's mainly selling the 10 largest cap companies. And Berkshire has been dancing around that top 10 regularly. So therefore, there's going to be net sellers in the largest cap companies, not because the companies have done anything wrong, but because they're in the index where all the money is, not only among U.S. advisors and investors, but all around the world.
Understood.
The largest investment in the portfolio of people outside the United States is the S&P 500 index fund.